Welcome to the show, everyone. Today, we're diving headfirst into a topic that's about as fun as a root canal, but unfortunately, just as important: recessions. Look, we're not economists here, but even we know that understanding the warning signs of an economic downturn is crucial. So, to help us all understand if we're heading towards an economic ditch, we'll be taking a look at 10 key economic indicators. Think of them as the canaries in the coal mine of the economy. Now, before we get started, let's be clear. Predicting a recession with 100% certainty is about as likely as finding a unicorn riding a roller coaster while simultaneously solving a Rubik's Cube. But by understanding these indicators, we can at least get a sense of whether we're headed for a slight economic speed bump or a full-blown economic meteor strike. So buckle up, buttercups, it's about to get financially fascinating. First up, we've got GDP, or Gross Domestic Product. GDP is basically the total value of all the goods and services produced within a country's borders in a specific period. Think of it like the economy's report card. If GDP is growing, it means businesses are humming, people are spending, and the economy is generally doing a little dance of prosperity. But if GDP starts to shrink for 2 consecutive quarters, well, that's what economists call a recession. GDP is our fuel gauge, people, and when it starts flashing red, it's time to take notice. Next up, we have the unemployment rate, which, let's be honest, is a pretty blunt instrument when it comes to measuring economic health. A rising unemployment rate generally indicates that businesses are struggling, people are losing their jobs, and the economy is slowing down. Not ideal, to say the least. Now, it's important to remember that the unemployment rate is a lagging indicator, meaning it tends to reflect what's already happened in the economy rather than what's going to happen. That being said, a significant and sustained increase in the unemployment rate is definitely a red flag. So, if the unemployment rate starts to climb faster than a squirrel on a double espresso, it's time to start paying attention. Now let's talk about consumer spending, which is basically the lifeblood of any economy. When consumer confidence is high, people spend money, businesses thrive, and the economy chugs along like a well-oiled machine. But when people start to feel uncertain about the future, maybe they're worried about losing their job, or the stock market is doing its best impression of a roller coaster designed by a sadist, they tend to tighten their purse strings. And when consumer spending drops, it sends a ripple effect throughout the entire economy. Businesses see a decline in sales, which can lead to layoffs, which can lead to further declines in consumer spending, and so on and so forth. So if you see reports of declining retail sales, empty shopping malls, and people suddenly becoming weirdly obsessed with couponing, it could be a sign that consumer spending is slowing down, and that, my friends, is not a good omen. The stock market. A magical realm where fortunes are made and lost with the click of a button, and where the only constant is the terrifying unpredictability of it all. When the stock market is doing well, you know, those times when everyone on your social media feed seems to be bragging about their cryptocurrency gains, it's generally a sign that investors are feeling confident about the future. They're pouring money into companies, those companies are using that money to grow and hire more people, and the economy hums along like a well-tuned symphony of capitalism. But when the stock market takes a nosedive, as it is often wont to do, well, that's when things get a little hairy. Investors get spooked, they start pulling their money out of the market faster than you can say margin call, and suddenly, the economy is facing a full-blown panic attack. It's like seeing a crack in the foundation of a building. It might not seem like a big deal at first, but if left unchecked, it could eventually bring the whole thing down. Alright folks, buckle up, because this next one is a real doozy: the inverted yield curve. Now, if your eyes just glazed over at the mere mention of the words yield curve, don't worry, I get it, this is some seriously wonky stuff. But trust me, it's important, and it's actually not as complicated as it sounds. Basically, the yield curve is just a fancy graph that shows the interest rates on government bonds of different maturities. Normally, this curve slopes upward, meaning that long-term bonds have higher interest rates than short-term bonds, but sometimes weird things happen in the bond market, and the yield curve inverts, meaning that short-term interest rates are actually higher than long-term rates. Bottom line, when the bond market starts acting weird, it's time to pay attention. Now let's talk about business investment. which is basically the engine that drives economic growth. When businesses are feeling optimistic about the future, they invest in new equipment, expand their operations, and hire more workers. But when businesses start to get nervous about the economy, they tend to slam on the brakes, putting a hold on investments and generally battening down the hatches. Now, there are a lot of reasons why businesses might cut back on investment. Maybe they're seeing a decline in consumer demand, maybe they're worried about political instability, or maybe they're just feeling generally pessimistic about the future. Whatever the reason, a drop in business investment is usually a sign that the economy is headed for a rough patch. So if you see reports of businesses cutting back on investment, it's time to start paying attention. Alright, let's talk about manufacturing and industrial production, which are basically the backbone of any industrialized economy. When factories are humming along, churning out goods at a steady clip, it's a sign that the economy is healthy and growing. But when manufacturing activity starts to slow down, it's usually a sign that something's amiss. Now, there are a lot of factors that can affect manufacturing and industrial production, from global trade tensions and commodity prices to technological advancements and changes in consumer demand. But a sustained decline in this sector is generally not a good sign for the economy as a whole. So, if you see reports of factory orders declining, manufacturing activity slowing down, and industrial production taking a nosedive, it's time to start paying attention. It could be a sign that the economy is headed for a stall. Now let's talk about the housing market, which, let's be honest, is often a source of both great joy and crippling anxiety. The housing market can be a fickle beast, prone to wild swings and unpredictable fluctuations. All that to say, the housing market is a crucial part of the economy, and a slowdown in this sector can have ripple effects throughout the entire system. When people buy homes, they also tend to buy a whole bunch of other stuff like furniture, appliances, and those weird decorative pillows that no one ever actually uses. But when the housing market cools down, maybe interest rates are rising, or maybe people are just generally feeling less confident about the economy, all that spending dries up, and the economy can start to feel the pinch. So, if you see reports of declining home sales, falling home prices, and a general lack of enthusiasm for open houses, it could be a sign that the housing market is headed for a downturn, and that's not good news for the economy as a whole. Let's talk about corporate bankruptcies and debt defaults, which are basically the economic equivalent of a dumpster fire. Nobody wants to see businesses go belly up, but unfortunately, it's a natural part of the business cycle. Now, a few corporate bankruptcies here and there are to be expected in any economy, but when you start to see a significant increase in the number of companies going bankrupt or defaulting on their debts, well, that's when you know things are starting to get a little hairy. A surge in corporate bankruptcies and debt defaults can be a sign of several underlying economic problems. It could be that businesses are struggling with high debt loads, declining sales, or rising interest rates. Whatever the reason, a spike in corporate bankruptcies is usually a sign that the economy is under stress, and it can have a number of negative consequences. For one thing, it can lead to job losses, as companies are forced to lay off workers in an attempt to stay afloat. And finally, let's talk about consumer and business sentiment, which, believe it or not, play a surprisingly large role in the economy. You see, economics isn't just about cold, hard numbers, it's also about psychology, about how people feel about the economy and their own financial prospects. When consumers are feeling optimistic, they're more likely to spend money, which, as we've established, is good for businesses and good for the economy. But when consumers start to feel pessimistic, maybe they're worried about losing their jobs, or maybe they just don't think the future is looking so bright, they tend to rein in their spending, and that can have a ripple effect throughout the entire economy. The same goes for businesses. When business leaders are feeling confident about the future, they're more likely to invest in new projects, expand their operations, and hire more workers. But when business sentiment starts to sour, well, those investment plans get shelved faster than you can say economic downturn. These indexes can provide valuable insights into how consumers and businesses are feeling about the economy, and they can be helpful in predicting future economic activity. So there you have it, folks. 10 economic indicators that can help us understand whether or not we're headed for a recession. The economy is a complex beast, influenced by a dizzying array of factors, From global pandemics and geopolitical turmoil to the price of crude oil and the whims of the Federal Reserve. Trying to make sense of it all can be enough to make your head spin. But that doesn't mean we should just throw up our hands and give up. By understanding the economic indicators we've discussed today, we can at least get a sense of which way the economic winds are blowing, and that can help us make more informed decisions about our own financial lives. Thanks for watching. Stay tuned for more insights into the economy and how you can navigate through these challenging times. Don't forget to like, share, and subscribe for more updates.